To know how the U.S. economy works, we need to focus on its major parts: the mother body of the U.S. monetary system, Federal Reserve System. Watch this video until the end to understand how this massive institution works. Hello, and welcome back to Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. The Fed has been in every economy-related conversation, but it's rare that many of them understand how it works. So, in today's video, we are going to see everything you need to know about the Federal Reserve. Before moving on, subscribe to the channel and smash that like button. Now, without wasting much time, let's get started. The Federal Reserve, or as we know it as the Fed, is the central bank system of the USA. It's perhaps the most powerful financial institution in the world and is commonly referred to as the Fed. It was created to give the country a safe, adaptive, and stable financial system. A 7-member board of directors governs the Fed. There are additional 12 Federal Reserve banks overall, each governed with its own president who represents a different district. The Federal Reserve System, an overview. A central bank is a financial body with supreme authority over the manufacture and distribution of money. It's typically in charge of monetary policy formulation and member bank regulation in contemporary economies. The Fed is composed of 12 regional Federal Reserve banks, each responsible for a certain zone of the United States. In response to the financial panic of 1907, President Woodrow Wilson signed the Federal Reserve Act on December 23, 1913, establishing the Fed. Previously, the United States was the only major financial power without a central bank. Its inception was prompted by the numerous financial waves of panic that ravaged the United States economy throughout the preceding century, resulting in major economic disruptions due to bank failures and corporate bankruptcies. A crisis in 1907 prompted proposals for the establishment of an organization to prevent panics and disturbances. The Fed has considerable authority to act to protect financial stability and is the primary supervisor of Federal Reserve System members' banks. It serves as the lender of last resort for member institutions that have no other options for borrowing. Its mandate is to promote financial stability in the system, and it's sometimes referred to simply as the Fed. It's also the country's primary financial institution regulator. The system's 12 regional federal banks are located in Boston, New York, Philadelphia, Cleveland, Minneapolis, Richmond, San Francisco, Atlanta, Chicago, St. Louis, Dallas, and Kansas City. Special cases. The Fed's major source of income is interest on a variety of U.S. government assets acquired through open market operations, interest on foreign currency investments, interest on loans to depository institutions, and fees for services such as check clearing and fund transfers offered to these institutions are all sources of income. The Fed transfers the remainder of its earnings to the U.S. Treasury after deducting expenses. The Federal Reserve Payment System, sometimes known as the Fed Wire, transfers trillions of dollars between banks across the United States on a daily basis. This allows the transactions to be settled on the same day. Following the 2008 financial crisis, the Fed focused more on the risk posed by the time lag between when payments are made early in the day and when they are settled and reconciled. The Fed is putting pressure on large financial institutions to increase real-time monitoring of payments and credit risk, which was previously only available at the end of the day. The mandate and duties of the Federal Reserve System. The Federal Reserve's monetary policy objectives are twofold: to encourage economic circumstances that result in stable prices and maximum sustainable employment. The Fed's responsibilities are further classified into 4 broad categories. Conducting national monetary policy involves influencing monetary and credit conditions in the United States economy in order to maximize employment, stabilize prices, and maintain reasonable long-term interest rates. Supervising and regulating banking organizations in order to ensure the security of the United States banking and financial system and to protect consumers' credit rights. Keeping the financial system stable and containing systemic risk. Providing financial services to depository institutions, the U.S. government, and foreign official institutions, including a critical role in the operation of the national payment system. Fed's structure. The Governor's Board of Fed has 7 people on it. These people are nominated by the President and confirmed by the United States Senate. Each governor has a maximum term of 14 years. To limit the president's president's power, their appointments are staggered by 2 years. The law also requires that appointments represent all major areas of the American economy. It's worth noting that only one board position remains vacant as of June 7, 2022. Boards of Governors of the Federal Reserve System. The independence of the Federal Reserve System. The term central bank independence refers to whether the overseers of monetary policy should be fully separate from the domain of the government. Those who want independence realize the role of politics in encouraging monetary policy that can benefit re-election in the short term but create long-term economic harm. Critics argue that the central bank and the government's economic policies must be closely linked and that central banks must be subject to regulatory monitoring. The Fed is also seen as independent because its decisions are not subject to approval by the president or any other government official. It is, however, still subject to congressional inspection and must operate within the confines of the government's economic and fiscal policy objectives. Fears over the Federal Reserve's balance sheet expansion and dangerous bailouts for companies like American International Group have prompted calls for greater openness and responsibility. Recent proposals in Washington for an audit of the Federal Reserve could jeopardize the central bank's independence. Federal Open Market Committee versus Federal Reserve System. The Federal Reserve's Board of Governors have the responsibility of setting the reserve requirements. This is the amount of money that banks must keep on hand in order to satisfy unexpected withdrawals. It also determines the discount rate, which is the rate of interest charged by the Fed on loans issued to financial institutions and other commercial banks. The Federal Open Market Committee, on the other hand, is the principal monetary policy-making body of the Federal Reserve. It's in charge of open market operations, which include the purchase and sale of government securities. The FOMC is made up of the Board of Governors, often known as the Federal Reserve Board, the president of the Federal Reserve Bank of New York, and the presidents of 4 other regional Federal Reserve banks who rotate in and out. The committee is in charge of making monetary policy decisions in 3 areas: maximizing employment, stabilizing prices, and moderating long-term interest rates. The first 2 of them are referred to as the Federal Reserve's dual mandate. Through FOMC decision-making, central banks around the world, including the Fed, have come to employ a mechanism known as quantitative easing to expand private lending, cut interest rates, and promote investment in commercial activity. Quantitative easing is mostly employed to stimulate economies during recessions when credit is unavailable, such as the 2007-2008 financial crisis. What does it mean for the Fed to be a central bank? A central bank is a financial entity that's in charge of a country's monetary system and policy. A central bank controls the money supply and sets interest rates in a country. Monetary policy is also implemented by central banks. Central banks try to keep a country's economy on track by loosening or limiting the money supply and credit availability. Who's the owner of the Federal Reserve? Nobody owns the Federal Reserve System. The Federal Reserve Act established it as the nation's central bank in 1913. The Board of Governors is a federal government agency that reports to and is directly accountable to Congress. Is U.S. money printed by the Fed? Though the United States Treasury Department issues coins, the Federal Reserve prints and maintains paper money, known formally as Federal Reserve notes. The Federal Reserve now issues notes in denominations of 1, 5, 10, 20, 50, and $100 bills. The $10,000 note was the biggest denomination of Federal Reserve notes ever issued for public circulation. How does the Federal Reserve determine interest rates? The Fed has an implicit inflation objective of 2%. The inflation targeting principle is founded on the assumption that long-term economic growth is best accomplished by maintaining price stability, which is attained by managing inflation. Inflation rates of 1 to 2% per year are generally regarded as reasonable, whereas rates of more than 3% constitute a risky zone that could lead the currency to depreciate. The Taylor Rule is an economic model that states that when inflation or GDP growth rates are higher than anticipated, the Federal Reserve should raise interest rates. Does the Fed collect taxes? No. The Fed is only in charge of monetary policy and banking system oversight. Government taxes are only approved and collected by Congress through the Internal Revenue Service, a federal body that's an example of fiscal policy. Actually, individual states and municipalities have their state and local taxes. Impact on your finances. The Fed's job is so sophisticated that it's frequently misconstrued or completely ignored, but it's not something to ignore. All of these selections will be felt in your pocketbook. When the Federal Reserve cuts interest rates, returns on consumer goods, such as savings accounts and certificates of deposit, fall. Auto loan and credit card rates tend to decline in tandem with Fed reduction, while they remain somewhat higher than the Fed funds rate. Mortgage rates are not directly controlled by Fed decisions, but they are influenced by the same external market factors that the Fed considers. When the Fed raises interest rates, those rates and yields climb, not to mention the massive repercussions of inflation for US consumers. When inflation rises, households lose buying power, and if it falls, the money in their pockets isn't worth as much as it once was. J.W. Sim, principal economist at Fed, explains, if you want to acquire a loan, the interest rate you pay on the loan is impacted by what the Fed is doing. If you are a senior adult living on a fixed income, you are quite concerned about the state of the economy's pricing. If you're a creditor of someone who is borrowing or a borrower, you are interested in what the Fed is doing. The Fed has a direct impact on the decisions you make. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down which thing about the Fed surprised you the most. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.